Welcome to the G360 Wealth Podcast. Today, I'm honored to be joined by Jack Vogel, who is Co-CIO of Alpha Architect and one of the leading experts in Section 351 exchanges. Jack, welcome to the show. Thanks for being here.
Yeah, thanks for having me on.
So let's take our listeners back to what is Alpha Architect and who is Jack Vogel? I'd love to just start at the beginning. Also, I love that name, Alpha Architect. Like building alpha just gets me really excited.
Yeah. Well, we had multiple failed names, so that's one that ended up sticking. So I'm Jack Vogel, co-CIO of Alpha Architect. I've been doing this with Wes Gray since 2010. At the time, it was kind of just an idea startup. So we've been doing this now for 16 years. Our first role was, I would say, we kind of served as like an outsourced CIO to a large, multi-billion-dollar family office in New York City. And then from there, we started managing money for the family as well as other individuals. The business has evolved throughout the years, so we do a couple of things. In 2014, we launched our first ETF. So that was like our foray into ETFs. And when we did that, we set up our own ETF operations, so our own, trust, trading, ops, compliance, databases, websites, you name it. So we set all that infrastructure up. And then we have two other business lines that have come along throughout the years. One is our 1042 business, which is, if you're a C Corp owner selling to an ESOP, we have a way to reinvest the proceeds there. And then another business line was, as I mentioned earlier, we set up these ETF operations. And as such, someone asked us, hey, can I launch an ETF using your ops? So we now run, besides our ETFs that we sponsor, we run like another, I think, 88 ETFs for other people. So we have those three business lines. And then I would say the newer one, and one of the newest things that we've been talking about the most is these things called Section 351 exchanges, which I know is what we wanted to dive into on the podcast today.
That's incredible. I love the evolution of the small business, right? It starts at, what am I going to call myself? I'm going to change that name like 5 times. And then what are we going to land on? And then, maybe these products down the road that you never even thought about, like selling to an ESOP plan or a 351 exchange, become these products that you're most known for.
I know.
So,
yeah.
Let's start at the very beginning, right? Most of our listeners know what we're talking about when we say ETF, but what is an ETF and why has that business really evolved over the last 10 years?
Yeah, so ETF just stands for Exchange Traded Fund, right? I'd say it's, mutual funds is what I would say was probably the original collective investment that was simple, right? So as an individual investor, maybe you want to put away, $100 for the month. And you don't want to just buy a stock, you want to just buy the market, right? So that was kind of mutual funds started where you could put $100 in and get, a smaller share of the S&P 500. And so the mutual fund will go out and buy all the stocks for you, the 500 stocks, right? ETFs then started in the 90s. The biggest difference there, right, is a mutual fund, you get one price per day, which is just the closing price. An exchange traded fund allowed individuals to purchase pro rata shares of these stock portfolios or bond portfolios throughout the day. So from 9:30 to 4 p.m. And so ETFs, I would say definitely we're lagging behind now. I would say might be the preferred investment vehicle for investors. Probably most likely, definitely for taxable investors, as ETFs have some neat ways in which they are pretty tax efficient and neat ways to access strategies for everyday investors.
Yeah, I think the other thing that people think about with ETF is low cost, right? And that's really been a big catalyst of folks driving towards these investment vehicles. But they're not all the same. Some are high cost, some are low cost. But let's get into it. So for this episode, we're really going to be talking to folks that have appreciated positions or appreciated portfolios. Over the last 10 years, there's been a lot of democratization of strategies to help manage these. They're not all one size fits all. Every portfolio is different. Every client is different. And the 351 exchange can really serve to help a lot of folks. They're all different arrows in the quiver, but let's start out with the basic. what is a 351 exchange?
Yeah, so 351 exchange, it's actually an older tax code from the 1950s that dealt really with like corporate reorganizations. And it kind of answered the question, hey, if I contribute property in exchange for shares of a new company, is that a taxable event? Right. So obviously you and I know, like if I use cash to buy shares of a new company, it doesn't matter because my basis is what it is. But 351 just kind of govern, like if you meet certain rules, you could actually contribute property for shares of a new company. And it was a non-taxable event. Right. So this is like an old corporate tax code that we're talking about today, and we're talking about ETFs because there were some rule changes. I would say about probably in 2019, went effective in 2020, and people figured out, hey, wait a minute, given these rule changes, why don't we combine these new rules with Section 351 and have a new use case, which is what we're talking about for 351. And so the use case is we're going to follow the same rule. We're going to contribute property for shares of a new company, but in this instance, and what we're going to talk about is we're going to contribute property, meaning like stock or ETFs, maybe those that have appreciated, in exchange for a new ETF. And if we meet and follow these rules, which are pretty specific, it is a tax-free exchange, right? So that's kind of the use case we're talking about is investors and advisors for their clients kind of have the ability now to contribute like appreciated property, appreciated stocks and ETFs in exchange for a new ETF.
All right, so let's talk through this in reality. So 2019 rules changed. Let's go back to where Alpha Architect stands. Are you guys getting this data in real time and putting the dots together and saying, wait, I think we can do something pretty cool here? And then how does that evolution happen to like actually launching a product?
Yeah, so the rule change there just made it whereby this is something where the ETF itself, basically funds are now allowed to be active and tax efficient. So that's kind of the big rule change, I would say, assuming you follow certain ETF rules, right? And so what happened was, about a couple of years after we were approached to help launch an ETF for someone else. And we're like, hey, we can use these new rules and combine them. And we did our first one for another firm in 2022 on the operational side, right? And then we had done a couple more. And then we realized, hey, what we, Alpha Architect, want to provide to advisors now is a solution to essentially every couple of months, hopefully, be able to contribute like appreciated stocks, ETFs, and get a new ETF back. And our goal there kind of is to just give like market-ish beta ETF, which can be beneficial.
So let's bring this to reality. So I bought Google, Apple, Microsoft for a bag of marbles 20 years ago. I've got a hugely appreciated portfolio. I've kind of spent my career. And now I'm looking at my portfolio. I'm approaching retirement, and I'm like, whoa, I've got like a beta 1.5 portfolio. I'm really allocated to these positions. I've really enjoyed the ride. Stock could keep going up, could go down. What I want to do is diversify my portfolio. Talk about like how the 351 exchange works and what the benefits are.
Yeah, so the 351 exchange in general is going to be good for potentially giving you better diversification, right? So as I mentioned before, a 351 exchange, we need to follow some rules. The most, I would say, important rules is you need to contribute a diversified portfolio, right? Now, diversification can mean a million things to a million people, but in the context of 351, the IRS outlined what they deem diversified to be, right? So there's two main rules that you have to do. The first rule is like your largest position needs to be under 25% of what you contribute. And the second rule is the sum of the weights of the top 5 positions need to be under 50%. So going back to your example, right? Let's say you had bought Apple, Google, Microsoft, right? And that was our only 3 positions. We'd have an issue there, right? Because there's only 3 stocks. So if we're only contributing stocks, right, we would need at least 11 stocks for it to mathematically work. Okay. But one of the neat things is we can actually contribute like ETFs alongside. So maybe, you had three stocks, but maybe you have another market cap ETF, like the S&P 500 ETF from Vanguard, like VOO, right? And so, maybe you have this Apple position that now is 20% of your portfolio. And you might be like, I don't know if I really want 20% of my portfolio to be an Apple. So if you contribute that along with like some other ETFs and stocks, you can get back probably what will be a more diversified basket. And you can do that in a tax-free event.
Got it. So putting this all together in practicality, client has or investor has diversified positions. They basically take those stocks, give them to Alpha Architect, and Alpha Architect gives them a S&P 500 ETF back.
High level, yes. Pretty much that's close enough to exactly what is going on. So not exactly tracking the S&P 500, but it's going to be very much like the market.
Exactly. So one of the things that we talk a lot about, Jack, here is simplification is the ultimate form of sophistication. So are you seeing a lot of folks trying to take maybe portfolios that we would call diversified, right? They've got 7 different separate managers at, whatever big bank. They have 400 positions and they have no idea what's going on in that portfolio. Are you seeing a lot of consolidation into these vehicles?
Yeah, that is a great use case that we have seen advisors and clients use, right? You come in with all these hundreds of stocks, tons of ETFs, like what is going on? When you kind of do all the analysis, you're like, wow, I pretty much have US stock market anyway, right? I might as well simplify my life, not have to worry about getting dividends from all these random positions.
And then how does that work with the basis, right? If like I bought all these positions at different times, there's a lot of different tracking. How does that all work? Like, what do you get in the end?
Great question. So 351 exchange, again, there's no step up in basis. It just basically transfers over. So if I give in, $1 million worth of positions, like that's the total value today is $1 million with a cost basis, let's say of 250,000, you get back new ETF shares with a value of $1 million and a cost basis of 250,000. So the cost basis kind of just maps over, right? There's no change in cost basis. We don't get a step up in basis. But what we can get maybe is maybe a better, more diversified portfolio than what we currently have. Or if nothing else, a simpler portfolio because it's going to be one ETF.
And typically, not at all times, but typically simple beats complex.
I would agree with that.
And then what about dividends, right? Like what if I'm in retirement? I want my dividends. I want that paper check in the mail. I want to feel and touch that dividend. Does this ETF distribute dividends?
Yeah. So it will distribute dividends just like any other ETFs do, right? So if you receive dividends, you have to pay them out. If you realize capital gains, you have to pay them out. And so, yeah, just like any other ETF, if dividends are received from the underlying stocks that the fund is invested in, essentially we pay them out.
Seems too good to be true. I bet this is probably pretty expensive. What are your thoughts on costs in these types of products?
Yeah, so we do understand that to investors and advisors, costs matter, right? And so we are really trying to offer this at what we think is a very reasonable cost. So the all-in cost, which is our management fee that we charge to run the fund, is only 15 basis points, so 0.15%, which we think is reasonable given like the infrastructure that we kind of had to build out to facilitate this. But we're giving you the market, so it's not 3 basis points like you can get SPY or VOO or and actually I don't know what SPY's management fee is. I could be off on that, but I know VOO I believe is like 2 or 3 basis points, so it's a little bit higher. But again, we are helping to facilitate by building out that infrastructure to facilitate these 351 exchanges.
I mean, that's obviously pretty reasonable, right? You're in the ballpark of S&P and you're getting
Mm-hmm.
all this consolidation and deferral. Let's talk about maybe a 351 exchange's cousin, like an exchange fund, right? Those are when we talk about costs, right? Those typically have much higher costs. Why would somebody, maybe let's talk some use cases. Why would somebody want to do a 351 exchange over an exchange fund? Why are you seeing the trend more towards 351 exchanges?
Yeah, so what I'd say is they kind of are like different use cases, right? So a 351 exchange, probably like your end cost might be a little bit lower, right? One of the other benefits, again, is you're going to get like an ETF back. And so when you get an ETF back, like there's no holding requirement on that. You can sell it if you'd like. Um, and so I think a lot of investors that already have a diversified portfolio, maybe with like, one larger position, a 351 exchange is probably a good solution for them. Now, exchange funds, those have been around for a long time using a different section of the tax code. And they have a couple of requirements that you need. One is if you contribute a position, you're going into like a limited partnership. So generally, it's going to have a little bit higher fees. The second thing is you're probably going to have this thing. It's a 7-year lock, right? Usually, for it to be, a tax-free exchange. The one benefit though of exchange funds, right? I kind of say like 351 exchange and an exchange fund is like different tools. Like we use them at different times, right? And so like an exchange fund, the one time or one instance it might be like more valuable than a 351 exchange would be a use case where someone has like $5 million in one stock and that's it, right? So pretend I had all my money in Apple, right? I knew Apple was going to take off when the iPhone came out, and I bought, $10,000 of stock. Now it's worth 5 million, and I have nothing else, right? That's my only asset. In that case, I can't really use a 351 exchange. So an exchange fund could potentially be a solution, right? But it's going to come with other rules like the 7-year lock and a little bit higher fees.
Got it. And in the 351 exchange, you just own that ETF. You can sell it the next day if you want.
Exactly.
Got it. As far as what this process looks like, right? It sounds complicated. You got to take these stocks, you got to get an ETF back. Like, how do the mechanics of this transaction actually work?
Yeah, so on the mechanics side, we've built technology to try to facilitate this and make it easier for advisors and individuals to participate. But really, kind of what happens is, about 2 days before we launch the ETF, we will actually like move the assets from the client account into the new ETF custodial account, right? And we need to do that because we need to ensure we actually get the positions, right? The client, though, is going to still be invested in that stock. So let's say all the positions. So let's say you gave me $1 million worth of securities on the 17th of the month. You would and we're going to launch on the 19th. Okay. You would still be invested until the close on the 18th. All right. At that point in time, that's when we do the important test, the diversification test, to ensure that all contributors meet the rules. Once everyone passes, right, you essentially have exchanged your positions in total for shares of this new ETF. And so we do it down to the penny. Uh, so you would get back the exact dollar amount. And basically, as of the close on the 18th, the open on the 19th, in my example where we're launching on the 19th again, right? You have exchanged your portfolio of positions for shares of a new ETF. And that new ETF is now comprised of all the positions you contributed as well as all of the other participants.
And then what are the client's expectations on performance? Like, what's the goal for tracking here? Are we getting close to the S&P 500, the S&P 1500? What's the output and expectation for clients?
Yeah, good question. So again, in the beginning, it's going to be a little, I would say, higher tracking error to the market, and I'm just going to say the market's the S&P 500, right? That's probably what we're going to be closest to, right? But in the beginning, it's going to be a little bit higher, right? Because we might be a little bit overweight or underweight certain positions relative to the market cap weight of, like, for example, the S&P 500. But over time, as we do assessments to the portfolio to better match the positions to what we have outlined in the prospectus. Again, the prospectus is just the document that governs like how we have to run the ETF. So as we maybe make some trades and change the portfolio, we hope to probably give you closer tracking to like the S&P 500.
Do you utilize the mechanics as you talked about initially in the ETF where it's a little more tax efficient to get that tracking error down?
Yeah, of course. So obviously, ETFs have an ability to use this things called the creation and redemption mechanism to, I would say, more tax efficiently rebalance the portfolio. And so, of course, yes, we're going to use that mechanism to rebalance the portfolio when we see fit.
So when we think about the 351 exchange, I want to talk about another popular product or strategy that's come to market the last 10 years is direct indexing.
Hmm.
I see the 351 exchange as a great landing spot for direct indexing. We've done another podcast on direct indexing and long short direct indexing, which you can reference back. But just as a reminder for our clients, direct indexing is the idea of deconstructing the S&P. And then the first goal is to keep the tracking error low. So to perform, whatever index you choose, S&P 500, 1500, to perform very, very closely to that. But along the way, harvest losses. But there's no free lunch, right? No strategy, is without, considerations. And one of those is that you depreciate your basis. And eventually the strategy ossifies, which I refer to as running out of steam, in simple terms. And why the strategy works well is it can help you rebalance a portfolio or diversify out of a position, but then eventually you gotta pay the man, right? You either have to rebalance down to tracking error, or you have to continue to pay the cost of uh, the manager fee for direct indexing. And once you're ossified, your whole portfolio is green. To get back to the tracking error, you might have to take some gains. And what you're ultimately left with is 200 to 400 positions that are all green, which is good, but you may not want to be looking at like a 70-page statement and a 1099 that's ridiculously long. Are you seeing a lot of use cases where people are saying, hey, I'm kind of all set with my direct indexing. It did what I did. Maybe it cost 20 basis points. Maybe let's save 5 basis points and move it into the 351 exchange. My statement gets a lot smaller. My basis rolls over, and then I don't have to worry about taking gains in the future to get back to where I need to be.
Yeah, I mean, a 351 is a great way to simplify these ossified direct index portfolio, whether it's just long only or long short. You're right. If you're not contributing new capital to these direct indexing portfolios, at some point they become ossified. There's no more losses to book. And if you don't want to manage 400 stocks, a 351 exchange is a nice way to take those 400 stocks and get back one ETF.
Have we done anything with long short yet? As have you been on the receiving end of some long short strategies?
So, not necessarily, but possible. Let me clarify why, right? So, an interesting thing is like in a 351 exchange, there are certain rules. Like I cannot take in levered positions and I can't take in short positions, right? So, what that means is if a client was running a long short direct indexing portfolio and they wanted to, essentially end it, right? Maybe they don't want to have any more leverage and there's really not a lot of losses left to book, or the, long short has solved the problem for the client and they just would like to simplify their lives. What would have to happen is you'd have to essentially eliminate the leverage in the short positions. And then you probably are going to be left with, similar to like a long only portfolio, just a couple hundred stocks, right? In which case, a 351 is a great way to simplify that remaining portfolio.
Yeah, and all these strategies, right, that we talk about, I think they all work kind of cohesively alongside of a really well-defined plan, like using a collar strategy or long short indexing or an exchange fund. Everybody has a different portfolio and different needs. But what I'm gathering from you is ultimately where we feel most of our clients want to land on is that simple portfolio. You can achieve the same thing, if not probably very likely better, in a portfolio that has 5 or 6 or 7 ETFs than something that has 800 positions because you're in the best in breed SMA. We used to say that in my past career. You're in the best in breed SMA, which what does even that mean? And you can simplify and be able to track and monitor. I think that's really important to be able to really follow your position, right? So the end state. What are we left with here? We're left with a single ticker that has hundreds of positions.
Yeah. Yeah. So I would agree with everything you said there, right? I'm a fan of simpler is better. And we're also fans of making things tax efficient, right? So doing trim trades on 800 stocks or turning it over, that's kind of crazy. Right. And so you are left with one ETF if you do a 351 exchange. You can take all these positions, contribute them, get back one ETF that is simple and has a pretty simple goal. Hey, I'm going to give you the market like return.
And what a terrific innovation that I think can really support, one of our initiatives, which is simplification. Jack, I think we've got a pretty strong outline here. So for our listeners who have listened to this, I think the key takeaway is, you got your 1035 exchange, your 1031 exchange. Now you get your 351 exchange, which you got to learn about, which is if you have appreciated positions that are diversified and you want to simplify getting into a simple ETF, this could be a really low cost, low pain, easy solution for you to diversify and simplify. Jack, thank you so much for your insight here. As we end every podcast, I want to give you the floor. What's going on at Alpha Architect? What cool things are you working on? What should people know about? The floor is yours.
Yeah, I'd say, at Alpha Architect, like I love talking about this stuff. So does Wes. So does Ryan. We love just talking about investment stuff. To be honest with you, and educating folks. So if anyone has any questions, let us know. But obviously, appreciate you having me on and going over this. And obviously, yeah, 351 is it's a really neat new tool that we're hoping serves a great purpose for both advisors and clients in the upcoming years.
Awesome. Well, for our listeners out there, if this was compelling to you or interesting, if you want to set up some time to meet with Jack and myself, we're obviously happy to coordinate that. I hope everybody found this useful in helping to strive for our initiative of simplification, tax management, and hopefully long and positive returns. Jack, thank you so much for being on today's episode. Your time is greatly appreciated. I hope everybody has a great day.
Thanks for listening to the G360 Wealth Podcast. If today's episode gave you something to think about or act on, share it with someone who might need it. Don't forget to hit subscribe so you're always in the loop. If you want to learn more about how we help families like yours simplify and grow their wealth, visit us at generationcapitaladvisors.com. Until next time, take care and keep building. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Generation Capital Advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Integrated Partners, doing business as Generation Capital Advisors, a registered investment advisor. The information in this material is for general information only and is not intended to provide specific advice or recommendation for any individual. Integrated Partners does not provide legal, tax, or mortgage advice or services. Please consult your legal or tax advisor regarding your specific situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss.